I've often said that in trading, it isn't the number of trades that make you rich, but the quality of them. And if you've been following me for a while, you'll remember in the previous video on the rule that makes trading predictable, we talked about how sticking to a set of tested rules is what turns chaos into opportunity. Today, I want to tell you about the two worst times to trade, and more importantly, why I sat on my hands and waited patiently instead of rushing into the market like a greenhorn. Because in this game, patience pays more than excitement ever will. Now let me ask you, have you ever felt that itch to jump into a trade even when the market didn't look right? That tug in your chest that says, do something, anything, because standing still feels unbearable. That's the devil whispering in your ear, and I know him well. I've listened to him before, and he's cost me more money than I care to count. The first time not to trade is when the market is uncertain, when it's shifting back and forth without direction. That sideways shuffle, where neither the bulls nor the bears have control. It's like watching a crowd that doesn't know where to walk, everyone bumping shoulders, but no one leading the way. If you try to jump into that mess, you'll get trampled. Have you ever walked into a revolving door, only to find yourself stuck going in circles? That's what trading in a choppy, uncertain market feels like. You enter, you move, but you end up back where you started minus the commissions. I learned long ago that uncertainty on the tape is the market's way of saying, sit down and wait. When prices don't move cleanly, when every uptick is erased by the next downtick, that's not the market rewarding the careful observer. That's the market hunting for fools. And make no mistake, the market feeds on impatience. Now here's the thing I've always believed, that the market shows its hand to the man who watches carefully enough. The trouble is, most men aren't willing to wait for it. They get restless, and restlessness is the ruin of traders. Did you ever notice how waiting feels harder than losing? Strange, isn't it? A loss feels like punishment, but waiting feels like torture. Yet waiting is where the money comes from. So the first bad time is obvious uncertainty, confusion, no clear line of least resistance. But the second bad time, that one is even more dangerous. It's right after you've had a big win. That moment when your pockets are heavy and your mind is drunk with success. Tell me, have you ever felt like a king after a profitable streak? Like every chart is suddenly speaking to you? Every candle a secret message meant for your eyes alone? That, my friend, is when the market sharpens its teeth. After a big win, your judgment is clouded. You no longer trade the market. You trade your emotions. You take trades that aren't really there. Because you're no longer looking for the market's signal. You're looking for the thrill of repeating that victory. And victories, in trading, are never repeated on demand. I remember once, after a strong campaign in cotton, I walked away with profits that could buy me a fleet of automobiles. My confidence was so high I thought I couldn't miss. The next morning I was back in the pit, taking positions left and right, certain the tape would reward me again. But do you know what happened? The market punished me for my arrogance. It was like the old street game of three-card Munter. I thought I knew where the queen was hiding, but all I did was feed the man dealing the cards. Have you ever made a win and then handed it right back to the market the very next day? That's the tax you pay for overconfidence. The truth is, the right move after a big win is to do nothing. To walk away, clear your head, and let your pulse settle. Because markets don't care about your last trade. They don't know you won. They don't owe you another one. That's why I say the worst time to trade is right after you've had a taste of triumph. That's when you're least objective. That's when you're most dangerous to yourself. Now let's step back for a moment. Why do these two times uncertainty and post-victory destroy traders? It comes down to human nature. Human beings hate waiting. We want movement, we want action, we want results. The market, however, doesn't reward action. It rewards discipline. Did you ever notice that the biggest fortunes aren't made by men who trade every day, but by men who trade at the right time? I've seen fellows who couldn't sit still lose a lifetime's savings, while another man who sat tight through a whole campaign walked away with riches. And it reminds me of what we spoke about in that earlier lesson, the rule that makes trading predictable. The rule only works because you're willing to wait for the market to line up with it. Predictability comes from repetition, from patterns repeating over and over. But if you step in during the uncertain stretches, you're trying to force predictability where there isn't any. Do you see the trap? The rule works, but only if you respect the timing. You must understand, wealth in markets isn't built from catching every tick. It's built from catching the right swing and holding it. When I talk about patient waiting, I'm not talking about sitting idle forever. I'm talking about reserving your capital, your energy, and your courage for the moment when the tape tells you the truth. And the tape always tells the truth, if you know how to read it. But only a fool demands it speak when it has nothing to say. Have you ever forced a conversation with someone who clearly didn't want to talk? The more you push, the more awkward it gets. The same with markets. When they're not speaking, your job is to shut up and listen. Silence is better than nonsense. Now let me confess something to you. I haven't always been patient. In my early days, the ticker tape was like a siren song. Every fluctuation was a call to arms. I thought I had to be in the market every day to prove I was a trader. But the market doesn't pay salaries, it pays for results. And the result of overtrading is ruin. It took me years and more losses than I like to admit to realize that my job wasn't to trade often, but to trade well. There's an old saying in Wall Street. The market is never wrong, but men often are. I'd add something to it: the market never hurries, but men always do, and it's the hurrying that kills. When I look back, my greatest profits didn't come from clever entries or lightning-fast exits. They came from sitting. Sitting through the noise, sitting through the temptations, sitting through the fear and the greed, and sitting out when the time was wrong. So, when is the time wrong? Let's make it simple. The time is wrong when you don't see the line of least resistance. If the tape isn't showing a clear trend, step aside. The time is wrong when you've just scored a victory and your blood is still hot. Step aside again. That's the discipline most men lack, and that's why most men fail. Have you ever stopped to wonder why only a handful of traders grow truly wealthy while the rest scrape by or wash out? It isn't knowledge alone. It's temperament. The market is a great equalizer of knowledge, but it punishes weak nerves. And this is where money mindset comes in. Because the man who must trade every day is a man desperate for income. He sees the market as his paycheck, and so he forces trades to meet his needs. But the wealthy trader, the wise trader, sees the market as a machine that pays only when conditions are right. He doesn't beg it for a wage. He waits for it to offer a fortune. That's a different way of thinking, isn't it? Instead of needing the market, you let the market need you. Tell me, do you see the power in that? When you're free from the need to trade, when you can afford to sit out the bad times, you suddenly become the hunter instead of the hunted. That's how fortunes are made, not in the busy hours, but in the waiting hours. And here's the irony: most traders fail not because they don't know what to do, but because they can't resist doing what they shouldn't. They know the market is unclear, but they jump in anyway. They know they're high on a big win, but they trade again anyway, and so they pay tuition to the market dearly. The real secret, if there is one, is this: learn to sit tight, not just on your winning positions, but also on your hands when the time is wrong. That's twice as hard and 10 times as valuable. Because when you wait out the 2 worst times to trade, you preserve not only your capital but also your confidence. And confidence preserved is opportunity preserved. Have you ever noticed how one bad trade in the wrong moment can poison your mind for weeks? That's the hidden cost of impatience. A bad entry during uncertainty, or a reckless trade after a big win, doesn't just hurt your wallet, it clouds your judgment for the next campaign. Suddenly, you're second-guessing yourself. You're no longer trading the market, you're trading your fear. That's why I waited patiently. Because I learned the hard way that waiting costs nothing, but impatience costs everything. And when I say waiting, I mean waiting actively, watching the tape, studying the action, preparing for the moment when the line of least resistance finally appears. Not idling, not dozing, but waiting like a cat crouched before the strike. Now you might ask yourself, but Jesse, if I'm not trading in those times, what am I doing? You're doing the work that others are too restless to do. You're observing, recording, analyzing. You're building the habit of self-control. And believe me, that habit is worth more than any single trade. Because in this game, the biggest profits don't go to the man who trades the most, they go to the man who makes the fewest mistakes. And the biggest mistakes are made in those two bad times. So when I tell you not to trade in uncertainty and not to trade after victory, I'm not preaching theory. I'm telling you how I lost fortunes and how I saved them. I'm telling you the truth the tape whispered to me again and again until I finally had the sense to listen. And the tape only whispers one thing in those moments: sit down. Be patient. The right time is coming. After a man has tasted success in the market, the danger isn't always from the ticker tape itself, but from what happens in his own head. Victory has a way of changing a trader's pulse. It makes his hands lighter on the trigger, his judgment softer, and his conviction sloppier. The moment after a big win is the most treacherous, because it's when confidence turns to carelessness, and careful reading of the tape turns into emotional chasing. That is why I say the worst time to trade is right after you've made a killing, because that's when you're least likely to see the market for what it is. You're blinded by your own triumph. Think about it. Have you ever walked out of a casino after hitting the jackpot on a slot machine and thought, I can do it again? That same pull happens in the market, only more dangerous, because the stakes aren't chips, they're your capital, your livelihood, your future. The tape is not a slot machine, but the mind convinces itself otherwise when success strikes. You believe the market is suddenly aligned with you, like you've found a secret key, as though the profits came from your brilliance instead of the natural movement of prices. That illusion is poison. The tape doesn't remember your last win. It doesn't know you were right yesterday. It doesn't owe you another fortune today. But how many traders fall into that exact trap? They finish a strong campaign, and instead of stepping back to let their pulse settle, they double down. They increase their size, they shorten their patience, and they stop waiting for the line of least resistance to show itself. In other words, they stop trading the market and start trading their emotions. Tell me, have you ever made a trade not because the setup was there, but because you felt invincible? That's the post-victory danger, and it ruins more men than the losses ever do. I remember one campaign in cotton that paid me enough to make any man comfortable. I had studied the tape, waited for the right setup, and ridden the swing patiently until it delivered. The profit was real, the reasoning behind it sound, but the next morning, flush with victory, I couldn't resist. I saw trades everywhere, even in places where the market was silent. I mistook noise for signal. The result: I gave back more than I should have, not because the market turned against me, but because my own judgment betrayed me. Success clouded my mind more than any failure ever had. The strangest part about victory is that it feels like proof of ability, when often it's proof of patience. But traders forget that. They credit themselves with skill when it was their discipline that paid them. And because they confuse the reason for their success, they misapply it the very next day. That's why after a big win, the best action is no action at all. It sounds simple, but it's the hardest thing in the world to do. Now, why is it so hard to stop after winning? Because the human mind craves repetition of pleasure. It's wired into us. One win creates the urge for another, just like one drink leads to two. But the tape doesn't work like that. The market doesn't give you victory on demand. It rewards you when the setup is right, when the conditions are in place, when the line of least resistance is clear. If you try to force another win simply because you want it, you're gambling, not trading. Have you noticed that a trader who just won big often trades larger size than before? It's as if he wants to prove to the world and to himself that his success wasn't luck. He raises the stakes, believing the market has confirmed his greatness. That is the precise moment when the market delivers its harshest lesson. Because markets don't confirm greatness, they test it. And they do it with ruthless consistency. The cure is simple to say, but hard to practice. After a win, cool off. Step away from the ticker. Close the books for the day, or even for the week if the campaign was large. Let the victory settle into your account before it unsettles your judgment. Think of it like cooling iron after it's been forged. If you rush it, the steel warps and weakens. Your trading mind is the same. It needs time to harden again before facing the fire. Another trap after a big win is the tendency to abandon your rules. You think, I've got a cushion now, I can afford to take a chance. But chances aren't trades. The moment you justify a position with "I can afford it," you're no longer trading with discipline. You're spending your profits like pocket change. That's how easy money turns into lost money. Have you ever heard of a man who made a fortune in one campaign only to lose it in the very next? It's nearly always because he stopped respecting his own rules. He let success loosen his grip. This is where the connection to money mindset comes in. A poor mindset treats profits like sudden windfalls to be spent or risked. A wealthy mindset treats them like seeds for the next harvest. But you can't plant seeds if you're too busy gambling them away. After a win, your job isn't to prove you can win again immediately. Your job is to protect what you've earned and prepare for the next true opportunity. The man who rushes back into the market after victory is the man who shows he doesn't trust patience to serve him again. When I talk about waiting, I don't mean sitting idle in ignorance. I mean active waiting, studying the tape, watching for confirmation, making notes, testing your own emotions. The real challenge after a win is whether you can go back to being a student instead of playing the role of a champion. Because champions in the market don't last long. Students last longer. Students keep learning, keep waiting, keep watching. Do you see how the market exploits psychology? After a loss, you feel fear, and the fear keeps you cautious. But after a win, you feel bold, and boldness pushes you into danger. That's why the second worst time to trade is after victory, because success removes the very caution that protects you. The tape doesn't need to fool you. Your own emotions do the job. One of the wealth-building principles that traders overlook is capital preservation after success. The big win you made isn't just money, it's momentum. It's proof you applied the right principles and held your nerve. If you can hold that capital instead of risking it recklessly, you build a foundation. That foundation lets you size up when the next true trend appears. But if you waste it in overconfident trades, you're back to where you started, with nothing to show for your discipline but regret. Now let me ask you, how many of your own winning streaks ended not because the market truly changed, but because your behavior did? The victory was there, the conditions were still ripe, but you squandered your strength by jumping too fast into setups that weren't real. If you look back at your record honestly, you'll see the truth. Most of the losses after wins came from emotional trading, not faulty reading of the tape. So the principle is clear. A big win is not an invitation to trade again, it's a signal to pause, to protect, to prepare. Think of it as a test from the market, asking you whether you've really learned discipline or whether you're still its servant. Most traders fail the test because they can't resist the thrill. The few who pass are the ones who grow truly wealthy. The market is a clever beast. It knows how to lure a man in with just enough movement to make him restless, and then it takes back his stake before he even realizes what happened. Restlessness is the trader's disease, and the market knows how to feed it. That is why I've always said the market punishes restlessness. It doesn't have to do anything special, the trader does it to himself. When conditions are unclear, when prices shift like waves against a seawall, the wise move is to sit still. But most men can't do it. They leap in, they churn their accounts, and they bleed capital little by little. Have you ever stood in front of the ticker on a dull day and felt your hands twitch, thinking, I need to do something? That's the moment when danger sets in, because the ticker is just spitting out noise, yet your imagination turns that noise into opportunity. You start seeing patterns that aren't there, signals that don't exist, and moves that never come. The tape isn't lying, it's just not speaking. And when the tape is silent, you must learn to be silent too. The market loves impatient men. It lives off their commissions, their premature stops, their false entries. It thrives on their need for action. I've watched countless traders who couldn't resist the urge to play every wiggle. They believed the game was about constant action, like a soldier firing every bullet he carries. But the battlefield of Wall Street is different. If you waste your ammunition on shadows, you'll have nothing left when the real enemy shows his head. In my early years, I made the same mistake. The ticker tape was like a riddle I felt compelled to solve every minute. I thought trading meant acting on every fluctuation, proving my skill by catching each move. But do you know what happened? I earned small wins here and there, but they were drowned out by the constant costs of being in the market when it had nothing to offer. Restlessness drained my account far more efficiently than a single bad trade ever could. There's a peculiar thing about restlessness. It makes a man believe he's working hard, when in fact he's just spinning his wheels. He thinks activity equals progress, but trading isn't like swinging a hammer or plowing a field. In those trades, effort produces output. In markets, effort without timing produces losses. The only effort that matters is the discipline to wait. Have you noticed how difficult it is to convince yourself that waiting is work? That's why so many fail. They confuse business with productivity, and they let the market teach them the difference in the harshest way possible. Now, let me ask you, how many trades have you made in your career simply to avoid the discomfort of doing nothing? Trades not backed by a clear line of least resistance, but by boredom or anxiety. If you add them up honestly, you'll see that they probably cost more than your big, obvious mistakes. Because restlessness is a slow leak. It empties the tank without you realizing it, drip by drip. And when the true opportunity finally arrives, you're too drained financially or mentally to take advantage of it. The principle of avoiding unclear conditions is not just about protecting money, it's about protecting judgment. Every bad trade you make in a restless state clouds your thinking. You become reactive, chasing losses or chasing the illusion of momentum. The tape stops being your guide and becomes your excuse. Instead of studying the action, you justify it. That's when trading turns into gambling. And gamblers, as you know, never last. I remember a stretch in my career when I forced myself into trades during a sideways market. Prices would move up for a few points, then down for a few points, back and forth with no conviction. I convinced myself I could outwit the chop by being quicker than everyone else. I thought I could scalp my way to fortune. What actually happened was death by 1,000 cuts. Each trade small, each loss minor, but the pile grew until it dwarfed the profits from my last campaign. The market didn't do that to me, I did it to myself. That's the punishment of restlessness. It's not sudden. It's steady, grinding, merciless. And here's the hardest truth. Restlessness feels productive because you're active, but it's really the market's way of testing your discipline. Can you wait? Can you watch the ticker spit meaningless numbers without needing to act? That's the exam every trader faces, and most fail it. The men who pass the ones who can sit tight. When the tape is muddled, those are the men who last long enough to catch the next great trend. This ties directly to how you think about money. A restless trader sees the market as a daily wage. He thinks he needs to extract profit every session, or else he's failed. That mindset forces him into the market, even when the conditions are poison. But the wealthy trader knows better. He doesn't need the market to pay him every day. He only needs it to pay him when the odds are right. He can sit idle for weeks if necessary, because he understands that one good swing is worth 100 bad scalps. That's wealth-building thinking, not paycheck thinking. Have you ever considered why the great fortunes came from long campaigns, not from constant trading? Men like me didn't grow rich by jumping into every move. We grew rich by waiting for the right move and then riding it without distraction. The difference between the wealthy trader and the restless trader is simple patience. The wealthy trader spends most of his time doing nothing, while the restless trader spends most of his time undoing himself. Restlessness also affects your emotions in ways you don't notice until it's too late. A string of small, needless losses makes you timid. It erodes your confidence. So when the market finally does reveal its true line of least resistance, you hesitate. You second-guess yourself. You think, maybe I'll wait one more day, and that day is the day the move begins without you. Do you see the cruel irony? Restlessness in dead times makes you paralyzed in real times. It robs you twice, once in money, and again in courage. There's an old saying in trading that the hardest thing is not knowing what to do, but knowing when not to do it. I believe that with all my heart. The tape doesn't always speak clearly. Sometimes it whispers, sometimes it mumbles, sometimes it says nothing at all. In those moments, if you force it to tell you a story, you'll invent one, and the story you invent will cost you. That is how the market punishes restlessness. It lets you trick yourself. The great secret is this: sitting still is a position too. It's the strongest position in the world when the market is uncertain. It costs nothing, it risks nothing, and it preserves everything. Yet most men treat it as weakness. They can't bear the thought of inactivity. So they pay for their need to act, and the market thanks them kindly. If you want to last in this game, you must learn to enjoy the quiet periods, to see them not as wasted time, but as necessary preparation. Every campaign I ever made began in silence, in waiting, in observation. The silence tested me, and when I passed, the market revealed the move. That's the rhythm of trading. But the restless trader skips the silence, and so he misses the move. Have you noticed how the market always seems easiest to read in hindsight? That's because the restless man was too busy trading noise to see the signal forming. The man who waited sees it clearly, because his judgment wasn't clouded by a string of useless trades. Patience sharpens your vision, while restlessness blinds it. A man's mindset about money determines everything he does in the market. You can give two traders the same chart, the same information, the same conditions, and they will act differently depending on how they think about money. One sees the market as a paycheck, something that must provide for him every day, no matter what. The other sees it as an opportunity machine, something that pays him only when conditions are ripe, but pays him handsomely when they are. That difference in mindset is the difference between scraping by and building wealth. When a trader approaches the market like a job that must deliver daily wages, he puts himself in bondage. He forces trades because he feels he cannot afford to miss a day. He measures success in short intervals, like a man who counts every coin in his pocket before going to bed at night. But the market doesn't operate on wages. It doesn't reward constant activity. It rewards alignment with the line of least resistance. If you demand daily pay, the market will give it to you, but it will be negative, because commissions, slippage, and bad trades will eat away at your account. Have you ever noticed how trying to make money every day ends up costing more than it gives? That's the trap of a paycheck mindset. The wealthy trader, on the other hand, doesn't think in terms of daily needs. He thinks in terms of campaigns. He knows that money in the market doesn't come like a salary, it comes in chunks, irregular, unpredictable in timing, but dependable in principle. It comes when he aligns himself with the big move, when the market tips its hand and shows him where the pressure lies. That might not happen every day. It might not even happen every week. But when it does, it pays enough to make the waiting worthwhile. The wealthy trader accepts the unevenness of the game. The poor trader fights it. Which do you think the market favors? I learned this difference the hard way. In my early days, I thought I had to trade constantly, because I needed to see the money flow in. If a day passed without a profit, I felt like I was failing. I forced trades to satisfy my need for activity, and those trades chipped away at my capital. The irony is, the days I thought I was working hardest were the days I was working against myself. It wasn't until I shifted my mindset, treating the market as an opportunity machine instead of a wage dispenser, that I began to see real wealth accumulate. Tell me, have you ever looked back over a month of trading and realized that nearly all of your profits came from just one or two campaigns, while the rest of your trades added little or even took away? That's the lesson in plain sight. The market doesn't care how many times you trade. It cares how well you catch the big swings. But to catch those swings, you need patience. And patience only comes when you free yourself from the idea of needing to be paid daily. Think about farming for a moment. A farmer doesn't plant seeds today and expect to eat tomorrow. He waits for the season, tends his fields, and harvests when the time is right. He doesn't dig up the soil every day to check if the crop is growing. If he did, he'd ruin the harvest. Yet traders with a paycheck mindset do exactly that. They dig up their capital every day, looking for results, destroying the very growth they hope to nurture. The wealthy trader is more like the farmer. He plants when the setup is right, he waits while the market develops, and he harvests when the line of least resistance plays out. Another part of the money mindset is how you view losses. The paycheck trader sees a loss as a failure, as a deduction from his supposed daily wage. That makes him fearful, reactive, unwilling to take the necessary risks when the opportunity arises. He trades small, trades often, and stays timid. The wealthy trader sees losses as part of the cost of doing business, like a farmer sees bad weather. He doesn't measure himself by any single day's outcome. He measures himself by campaigns, by seasons, by the larger arc of his capital.